Hey, YouTube family, aka homies and homettes. Welcome to another video of the Kevin Strong Show. I am your host, Kevin Strong. Welcome to my channel. And in this video, we're going to talk about the bad economy, everything that's going on in the economy, specifically what's happening in the banking industry. And we're going to talk briefly a little bit about housing and basically consumer debt overall. So if you're new to my channel, welcome. I ask for you to humbly subscribe, smash that like button, comment, and share because I care. So without further ado, we're going to jump into this video. I'm very excited about this. I do appreciate the guys and gals who do watch my videos on a consistent basis. So without further ado, let's go ahead and jump into this. Let's see here. Okay, and my little emblem there, the top right corner, is kind of blocking out that it says Mayday, Mayday, and the plane symbols our economy. We haven't totally crashed in a sense, but we're heading that way. So first of all, we're going to talk about banking in America. Just some information that some of you guys may not be aware of. Brokerage accounts are not FDIC insured. Brokerage accounts like with Fidelity Investment, Charles Schwab, TD Ameritrade, brokerage accounts like that are not typically insured by FDIC. If you do have something like a cash management account, that's a term that's used by Fidelity. Typically, that is FDIC insured. So make sure you check with your financial institution to make sure your money is covered by that particular government entity. Moving to the next point, the FDIC does not insure money invested in stocks, bonds, and mutual funds, life insurance policies, annuities, municipal securities, and money market funds, even if these investments were brought from an insured bank. So understand that sometimes a credit union or a regional bank or maybe one of the big brokerage companies out there will offer you a CD saying, hey, we can get you 3 or 4% return on your money. Understand that's not FDIC insured. The reason why I brought that up is because a lot of people don't know that. 401ks and IRAs are typically insured by FDIC. FDIC is basically broke. I'm going to skip a little bit here, but they're actually broke. They're insolvent. So there will come a point in time, in my humble opinion, that if this run on the bank system continues, they're only going to be able to bail out so many financial institutions because there's just not enough money to go around. One of the counterpoints to that is that the Fed will just print, aka add more digital numbers to a screen to basically shore up the banking system as it continues to implode, which will inevitably lead to inflation, just like all the stimulus did back in 20 and 21. And now we're dealing with inflation today. Silicon Valley Bank was insolvent in 4 hours. The reason why I'm bringing this up, people love technology. We love technology on our phones and things of that matter. But consider this, the speed at which something can be positive has the same speed as something that can be negative. So Washington Mutual lost $30 billion, I think, back in 2008. And as that point on the slide indicates, that took about 6 days for them to lose $30 billion. But because of technology and the nanosecond in which transactions go from one financial institution to another, the Silicon Valley Bank became insolvent in half of a business day. And it lost almost 3.5 times more money in just 24 hours. So if you don't have money out of the banking system, if you're not preparing for what's ahead because of technology and the way things are moving so quickly, you're not going to be able to react fast enough, in my humble opinion. So we're going to go ahead and continue with banking. The US, 2.3 trillion worth of notes and coins floating around the globe. 90% of your money does not exist. Now, I've talked about this ad nauseum in previous videos, but we're going to talk about it again briefly right now. There's roughly about 2.3 trillion physical dollars or coins circulating in the world. 90% of the money that exists in the United States exists in the form of digital. It's just numbers that you see on the screen. Some people in small circles that are growing into larger circles are starting to believe that having physical cash, it truly is an asset, so to speak. because the digital numbers that you see on the screen don't exist. Keep in mind, folks, this is very, very, very important point, that 90% of the money in the United States is just digital, only 10%. So if you got $1 million, you do the math. You really only got $100,000, statistically speaking. So what are some of the recommendations, which is not financial advice? Hold physical cash, which is rare. I just talked about that. Get it while you can. As they say, get it while it's hot. 2 for a cot. 2 for $1 make you want to holler. So anyway, obtain physical gold. Don't just trade the derivatives of gold and silver on the stock exchange. Physically get your hand on some gold and silver. It's not necessarily a return on your investment, but it is preservation of wealth. Consider purchasing T-bills. You can go to treasurydirect.gov's website. You can purchase it directly from that. I've done that and continue to buy T-bills. I'm going to buy some more T-bills next week, just as a backstop, just to have some kind of diversification, having some money out of the system, having some T-bills, having some gold, having some silver in your portfolio. Don't exceed $250,000 at one institution. Okay, so you can't have like 250 in your savings and 250 in your checking. Do not exceed $250,000 collectively at one financial institution. If you do have to keep some money in the bank, consider a credit union, the lesser of two evils. The majority of loan exposure to credit unions is typically automobiles. And with the big banks and the regional banks, their exposure is to mortgages, which in my humble opinion are getting ready to explode. Not even to mention what's happening on the commercial thing. I mean, the commercial industry is just getting ready to just make 2008 look like a walk in the park. So some of those regional and bigger banks, I think, are a little bit more susceptible. There is a theory out there that says they're trying to scare everybody to run to these big banks. So it'll be easy to just switch us over to some type of digital currency so they have complete control of our spending habits. You dropped the bomb on me. I think that was I can't remember the name of that damn band. DAS band, I think. So total credit card debt has reached almost $931 billion by the end of last year. That's a report according to TransUnion. The average balance has basically gone up and consumers are at their breaking point, according to a Wallet Hub study. So Social Security, right? Some of us don't think about it. Some of us are a little bit closer to drawing on that than others, but nevertheless, Social Security fund pays retirees benefits will be depleted by 2034. Now, I've heard this before. I've heard one report that says that the Social Security system is due to become insolvent within 9 years, assuming we don't have a recession / quasi depression, which could exacerbate and contract or speed up that time frame quite quickly. Whether or not they will backstop that, I tend to believe they will, or they'll probably put some kind of stopgap measures in place, like raise the eligibility for full Social Security. That's something that's already in play. I think that's something that will be revisited. They may talk about cutting future benefits down the line. So who knows? That's a very, very volatile moving target. If you're relying solely on Social Security to finance your retirement, I strongly suggest you start working on a second source of income just as a backup plan. Okay, Fed increasing its balance sheet, more inflation 12 to 18 months. So this might be a little difficult for you guys to read, but I'll just direct your attention over to the right side of that chart where you see there was a big increase and then it rolled down and now it's starting to pump back up. For all practical purposes, in my humble opinion, that's just quantitative easing, right? Artificially putting money through the digital system into the economy. And as a result of that, you get inflation. So we could get a dead cat bounce as the Fed probably pivots sometime in 2023. Mortgage rates are going to come down. Some suckers are going to jump in and catch that falling knife, the housing market, right? And think that everything's fine and dandy. And then, voila, sometimes probably around mid-2024, it's going to roll back down and housing potentially could collapse. So if you do decide to buy housing, I say proceed with caution. Make sure you're getting a good deal. I would not be paying listing price in this environment. And if you are looking at investment property, please make sure you are cash flowing. What can the Fed do? So here's something called the federal fund rate. Some of you guys may be familiar with this, or you've heard terms in the media talking about how high will the Fed raise interest rates, So this is basically a chart, historical chart going back to like 1950 something, that shows how the Fed has been moving in terms of the federal funds effective rate. So as you can see from 1980 on down, that line gets smaller, smaller, and smaller. The easy conversion to explain this graph, the more debt we have accumulated as a government and as a society, the Fed can't raise rates as high as it used to because we can't afford to pay all this debt back at a higher rate because the financial system would implode. So as you can see back in 2008, the Fed raised the federal funds effective rate down to 0. And it maintained that almost until 2012. Ironically, during that period of time, that was right when the housing market was crashing. So historically speaking, even when during the financial crisis, when the Fed lowered the federal funds effective rate down to 0, home prices continue to go down in value for years, and they didn't come out of that bottom to around 2012. And that's why I said in a previous slide, do not get caught in a dead cat bounce where you see a reprieve in the rates, the mortgage rates. You jump back in, even though home prices are at an all-time high still, ultimately to find out that you caught a falling knife. So it's very, very interesting to see how this thing plays out. I think, in my humble opinion, I think they'll reset the system when it gets to the point where the financial system is getting ready to collapse. But in terms of what the Fed is going to do, in my humble opinion, I think that the bond market is clearly telling the Fed, you got to slow your roll, homie. I think you've done enough. Here's some summary points. U.S. banks are currently sitting on $640 billion in unrealized losses. Wait until these mortgage people start to default on their mortgage payments. These car loans, this subprime car loan industry is imploding. Wait till all of this bad debt starts to roll on these banks' books and their balance sheets. That also is going to suck the liquidity and the profit out of these banks right at the same time that you have all of these people trying to get their money out of the bank. That's why they're trying to pass on the narrative that everything is stable, everything is okay. Janet Yellen is on record saying all banks will not be bailed out. I'm sure some of you guys have seen this. So she went before Congress and they were saying, hey, was this Silicon Valley Bank an isolated incident? And basically she was just saying, hey, don't be surprised if your temperature starts to rise, because if you in the wrong place at the wrong time and your bank becomes insolvent, she basically went out on record and said, hey, you may not get bailed out. Here's an interesting thought before I give you my last point and wrap this video up. This is something I was thinking about just before I uploaded this video, and I'm not political. You guys know that. But here's something to think about. There was a lot of well-funded, solid A-credit banks that wanted to take over Silicon Valley Bank, and the Biden administration blocked that and says, no, we're going to bail them out with FDIC. I wonder if the rationale behind that would be if the wrong bank took over Silicon Valley Bank and all of those deposits, or a lot of those deposits, have foreign ties to China. You see where I'm going with this? And now you start to connect the dots, and maybe some kind of way there is a way to connect some type of impropriety in terms of all the stuff they've been talking about, his alleged connections with China and his son, Hunter. So maybe that's one of the reasons why he didn't want another bank looking at all those deposit records and wanted the FDIC to take it over. Finally, last but not least, last year, the Fed had its first operating loss since 1915. And for those of you who are not historians, that's before the Great Depression, which was in 1929 to 1930. So that's really, really something to think about, right? 1915, it's been over almost 117 years, 18 years since the Fed had an operating loss. Something seriously is ominous about our financial system. Our financial system was supposed to implode back in 2008. They stopped it. and they inserted quantitative easing, and we've been on cheap money ever since. So don't be surprised if your temperatures start to rise. Get some money out of the banking system, buy gold, buy silver, start to educate yourself about macroeconomics so you don't become a victim, or you can at least minimize what happens to you and your family. So I'm going to end this video with my famous slogan: keep your credit score up and your debt down. If you have not subscribed to my channel, I humbly ask that you do so now. Please like and smash that button. That does help me out, and comment. This was the Kevin Strong Show, and I'll see you guys on the next video.